first trades then on your screens. Let's start off, of course, not just with the Nifty, which has opened very, very flat, just clinging on to that 19,800 trend, but IT. Let's see what's the street reaction and verdict on TCS. Nifty IT slips by about 0.4%, and I think it should be TCS dragging it lower. 1%, so that's a very mature reaction, you'd have to say, from the street. It's not a big gash down, and it's not really caving in what the likes of TCS and the rest have done in the last 52 or in the last month or so. Infi as well, marginally soft ahead of its numbers. Let's check in on what the other names are up to. What is Cipla then up to? Because Invagen has got an EIR for the New York unit with a voluntary action indicated status as well. Cipla holds out by 1%. JSW Steel, which is declared as the preferred bidder for one of the Jaisinghpura North blocks. So look out for what that stock does. There's Aurobindo Pharma, which has signed an LOI with Merck and Dome for a contract manufacturing segment. Auro Pharma jumps up 2.5%. RVNL, which has emerged as one of the lowest bidders for Northeast Frontier Railway project, that stock holds out 1%. Sula has come out with an excellent quarterly update, so look out for what that stock does. And similar is the case with Sami Hotels as well. That came out with its earnings. This is a relatively new listing, but the margins have come in lower actually on a year-on-year basis for Sami. 24% is what they've delivered versus a comparable of 31.3%, and the EBITDA as well has come in lower by about 14%. So this is a bit of a disappointment, as is the case with the Delta Corp, Patanjali Foods as well. The second quarter, clearly they've seen pricing pressure. I don't know if the stock is going to face any heat on back of that or not. And then yes, Zaggle has been quite the disappointment too, as has been the case with Signature Global as well. So these are a couple of disappointing factors in the market right now. There's UBL, wherein Novama has initiated a buy with a target price of 1935. Look out for that as well. They're saying that the appointment of the new MD is a renewed steady push for the company, 1% higher on this one. And then ICICI Securities, after the hike in target price on Zomato from 120 to now 160. Let's see what Zomato is up to in trade. That will just come off you on your screens. 2.5%, a solid start for Zomato. 1111 is where that 111, I beg your pardon, is where that stock is right now in trade. Any other trends that one can see? Let's revisit Hero MotoCorp, Ramco Cement, Ultratech Cement. These were some of the flavors of yesterday. Hero MotoCorp continues its uptick. Ramco Cement flat. Ultratech will just come up for you on your screens next. And yes, let's check in on what Reliance as well is up to and what HDFC Bank are doing, considering that 1.5% off an up move on Reliance yesterday. Today it starts off flat. So is the case with HDFC Bank as well. Kunal, it's directionless so far. Where are we headed next?
Yeah, so I expected more of a range-bound action for the indices. So let's hope. I think the first half an hour, first 1 hour, you would probably expect the indices to stabilize at this 19,800 mark. What we are actually doing is upping the base for the index. I think that's a good sign for the indices. Opening trade, I would still prefer larger cap names. So I would go with Reliance Industries as the opening trade. Looks very interesting, especially after yesterday's recovery for the stock.
Right. Naresh, what are the first trades that you're punching in?
So looking at further follow-up in JK paper. So looking at a buy on dips, starting off with a small position at current levels and add during the day.
Right. Ajay, any stocks that you're spotting right now in trade?
I'm actually watching out for Aurobindo Pharma, Aisha. The Aurobindo Pharma, out of the entire large cap pharma pack, is one which has pretty much moved up from 600 to almost above 900 mark in the last few months. And now they are entering a new area of therapy. And there is a lot of promise getting built in. Pull up Aurobindo Pharma 3 months, 6 months, and you would see 2% gain coming in today as well. Nuresh, what are the charts telling you? Is it readying for 1,000 level kind of a mark in the next few days? Or if one is already riding long position in Aurobindo, what should be the strategy?
So the stock has continued in a higher top, higher bottom formation. There has been a little bit of a pause in momentum over the last 3-4 weeks. But today's move is a further indication of again a possible breakout about 925, 930 to happen. So now a trading stop loss at 900 and continue to ride on to the position. It's clearly shown a lot of strength in this recovery from 400, 450 levels. So Trailing stop loss is the best way to go here.
Names as well continue to fly around, including the likes of a Shilpa Medicare, Moil. You've also got something like Elgi Equipment, as well as BSC, Minda Corp, and as we have already highlighted, Delta Corp, that's currently in the green by about 3%. But let's hear out a top market voice then. And Ajay Srivastav of Dimensions Corporate Finance spoke about his outlook on individual sectors, real estate, auto, as well as some of the other sectors that he's positive on.
Reality stocks have a two-way component. One, of course, is, I'm going to tell you a joke about this one of the largest real estate companies. MD told me that, and they have a garment business as well, that it's easier to sell a 2 crore house than a 20,000 rupee jacket in this country. And which tells you the story right now, that there is a frenzy out there in the market. And when you buy into a frenzy, you will pay for it. And I think people who are buying real estate today, or you buying into real estate companies, except, and I'll come back to that, are not going to get the best possible return. You can get a short-term return, but definitely not from this way, because you're buying a real estate company at the land rates of today, hoping that you will make a 20% plus return on your portfolio in the next 5 years. Now that takes it, the property prices need to double really to give you that kind of return. I don't think that's going to happen at all. Unless you have something like a company like a North Indian Diversified company, which has got rental yields coming into the portfolio in a significant way. I think those are the ones which will gain in the end because annuity income comes in. Unlike a pure play company which are standalone, that they sell the houses and they book the profit and they go away. So I would rather bet on real estate where there are good annuity incomes from commercial and properties coming, office properties, than just pure play, just the housing kind of companies. So pick your choice, but it's going to be very difficult for real estate companies to beat the market returns in the next 3 years from where they stand today.
Okay, fair enough. That's your take on the entire real estate space. And autos really have been in top gear. Ajay, what's your outlook? They're talking about how the premium end as well is doing very well. What's the expectation when it comes to the festive season? Would this be a good space to bet on?
Oh, of course, it's going to be a good season. I think, India's upper tier consumption story is absolutely intact. It's the lower end 70%, which is the problem. The top 5% doing well. I live in the same complex you mentioned, the Camellias, which is prices are going berserk. There is no barrage on buying stupid. That's in the world. A lot of people, money is lost. You saw SoftBank, right? Buying atrocious prices, but that's okay. Somebody's got too much of money, doesn't care about 100 crores. That's fine with that. But the point still remains that the upper tier of India is earning well. The wealth is increasing at this point of time. And just remember one thing. The reason upper tier is doing well is that we got a big tax cut in this corporate market, which became 25%. So while I pay a 42% tax, a company earning 5,000 crore only pays 25% tax. Now, all that benefit of tax has now gone to the promoters and the HNIs and to the corporate market, stock market as well. So remember this, and now if you set up a new company, the tax rate is 15% for manufacturing companies compared to 42% individual income. So upper tier business families, industrial families, stock market owners are all gaining at this point of time. No reason for upper tier consumption story. 5-star hotels, you've seen what's happening there. Travel, you've seen what's happening there. You've seen the remittances abroad going absolutely skyrocketing. So upper tier India, perfect shape, will going to spend money, and there's no problem at all. If you're betting on the economy end, I think that's where the problem is and the pain is.
Quite interesting. Ajay, what do you then do within the rest of the market? I mean, what is it that you actually avoid at this point? Anywhere you feel that the valuations are exuberant and have run up ahead of the fundamentals?
No, I think we just need to keep away from chemicals for the time being. I think they're too overpriced given the market conditions. That's some sector we're not going to be in. I think we are almost out of pharmaceutical at this point of time. The run-up, pharmaceutical run-up happens actually once in 5 years. And that run-up has already happened. I think by and large, the story has played out for a superior return. And remember this, our threshold also has gone up, because if I'm getting 9% or 12% in fixed income with almost negligible risk, I need to find stocks to give me 18% plus return in the next 3 years. Therefore, I don't see chemicals as a story which will give me that kind of return. I don't think pharma is a story which is going. We have returning back to little bit on the banking space, not the NBFC, but banking space. I think we're going to be there right now. Capital goods, fantastic story. Don't worry about it. Defense, lovely story, because there is no supply of stock coming there. There's more demand of stock And I think, if I'm not wrong, one mutual fund has it that you can't buy bulk, a defense sectoral fund, you can only buy in SIPs, which tells you that there's paucity of supply of paper in the industry. So I think capital good, the defense, I think there is a reorientation of companies who are launching in paint business. Wonderful. One sector I will do not buy, and I will not buy, is low-end consumer and retailing sector. Poorly performing companies, poorly performing returns, including our largest company in India. That sector I'm avoiding totally. So I think consumer retailing is absolutely zero. It's out at this point of time. And chemicals hold, pharma out. That's the way we are watching. Capital goods continue, defense continue, hotels love it.
If you pull up the liquor stocks, United Breweries has a new man at the helm. He was former MD at PNB Australia, and there are some brokerage notes which are quite upbeat on him. The stock is gaining about 0.5%, about $10. United Spirits is also consolidating above the 1,000 mark very nicely because of the data coming in. But Aisha, Awan, did you check out the Q2 updates of Sula?
Yes,
I have
we
a
did.
quiz for you, a question for you.
Yeah.
Aisha, let me come to you.
Okay.
For every liter of premium whiskey which is consumed in India, you know how much wine is consumed compared to that?
5 liters?
Any idea?
5 liters? 5 liters?
1 teaspoon.
No
1
way.
teaspoon. For every liter of premium whiskey, 1 teaspoon. And that's the size of the opportunity
No
which
way.
Sula is the only play for.
Wow,
And it is getting reflected in the numbers.
Yeah, clearly it is. And, as the management has as well alluded to, that their own brands, that growth has been about 11%, 116 crores. And even in H2, there has been a growth of about 22%. Yep. So like you were saying, that's some pretty interesting data. Clearly, you've been doing your rounds and chatting around with a lot of people about their beverage drinking patterns in Delhi, it seems, Ajay.
Awan, Delhi, of course, as Aisha would know, that is a region of whiskey drinkers.
Yeah.
And Ajay Srivastava's favorite stock is also United Spirits. But now the country is changing its consumption patterns on all of this, and wine is emerging. And I mean, still, I was just talking to one very large shareholder of Sula. He was telling me that the reason they've taken a large bet on Sula is this comparison.
Yeah.
Predominantly a country of whiskey drinkers or hard liquor consumers, now also opening up to the idea of wine, and the consumption pattern difference is so huge. For every liter of whiskey, just 1 teaspoon of wine. Even if this gap comes down, the volume growth for players like Sula and many others on the unlisted side could be very huge, and that is what interests people coming to this particular stock.
Yeah, absolutely. While I'm amazed with that trivia, Ajay, I mean, I thought it would be way higher, the wine consumption. But the only hitch here is that Sula then needs to focus on the premium segment, because the wine drinkers or aspirant wine drinkers want to upgrade from the traditional Sula, right? Because, we've seen the premiumization trend that's played out across sectors. So Sula really needs to focus on that part of their portfolio if they want to capture the new urban youth, which is now, getting into the alcohol drinking age limit and getting started with wine as well. So that's where they should focus on. But anyway, Sula is definitely bubbly this morning. That's holding up well. In fact, the entire liquor sector is looking very, very smart. 3% of a move coming in on Sula. That's where the stock is right now. But we chatted with Siddhartha Bhaiya as well from Equitas Investment Consultancy, and he believes that it's actually media valuations which have corrected quite a bit, and he actually finds value in this particular sector.
I opened the newspapers, and today I see 6 to 8 pages of advertisement on the front page, and particularly with all the IPO companies coming up. So whether it is print or whether it is digital or whether it is television, I think the valuations have corrected quite a bit. And they were kind of factoring in bankruptcy valuations, whereas their balance sheets were pretty healthy. At some point in time, say a year back, some of these companies had more than 50% net cash on their balance sheet, and they were available at 3 and 4 P multiple. Today, with elections coming in, ad rates are going to go up. With such huge IPO market, you're seeing demand for advertisement, even in newspapers and print, going up significantly, right? So, and with the Cricket World Cup also coming in, So yes, the valuations were attractive, and I think the growth has come back in, and hopefully the stocks will continue to re-rate. There's hardly anything that we have exited in the last 3.5 years. The portfolio from March 20 to now, we've gotten more flows and we've added new stocks, but we hardly exited anything in the last 3.5 years. Anything meaningful. Maybe we would have booked a little bit of profits here and there because our positions have increased significantly. Like something like an APAR has run up 10x in the last 18 months. So we might have booked a little bit of profits over there because the portfolio weightages have increased significantly. But besides that, as I said, from a structural perspective, we were invested in, say, capital goods or power sector or infrastructure or railways way before anyone else was even looking at those sectors. And we were invested because the valuations looked attractive. We invested in media 12, 15 months back. At that point in time, nobody was looking at media sector. So kind of our vision is longer and we're willing to ride a multi-year wave rather than move in and out of stocks quickly. I think the financials trade has kind of played off well. If you look at it, financials have underperformed and they continue to remain at risk with the US interest rates going up. And domestically also the liquidity has now become tighter from a surplus of nearly 2 lakh crores, 3 lakh crores. We're now at a neutral liquidity as far as domestically we are concerned. So we see interest rates going up in India as well. The yield gap between US and India has come down, has shrunk massively. So I think financials will remain at risk. I see both deposit rates and lending rates going up. So yes, I would still be, underweight financials.
All right. So there's one section of the market which is doing phenomenally well in the last few days, and that has been real estate. That stocks have been doing very well. The Q2 updates, if any reflection of how the quarterly earnings would be, very healthy. And one such company is Prestige Estates. Irfan Razak is joining us now to talk more about the trends taking shape. Mr. Razak, good morning. Thank you so much for your time. I was looking at the numbers. After a record Q1, the way momentum is continuing, it appears that post Q2, you would achieve almost 70% of your guidance already. So would you be seeing a case to up your guidance going forward? The momentum was higher than what you had estimated when you first made that estimate for the future?
Good morning. Yes, when we estimated the guidance, we had done 13,000 crores approximately the previous year. And we thought that to give a guidance upwards of 25% for the current year would be just prudent. But yes, we've got some good launches that happened and there has been great momentum. So that has taken us for 6 months at 11,000 crores. So we are pretty confident that we can cross and touch the 20,000 mark. And that will be the endeavor now. We have a lot of launches in the various cities that we operate in. Once the approvals are in place, the RERA numbers are in place, I believe the demand is still there. And if you are able to offer a good product at a good price, there will be a lot of traction. And that is the endeavor. The teams are working hard. They've worked hard, and I think they definitely will try and achieve this target. And I don't see us slipping there.
Mr. Razak, I'm in Delhi right now and was talking to some realty developers in the region, got good feedback. Now you're aiming to expand in the north region as well, in Noida in particular. How's the traction and what was your overall calculation? Because very few players actually have been able to, do a pan-India kind of a network. And even Prestige, after consolidating and becoming a very strong player in the south, now is looking at north and west. So what was the thinking and how's the Noida project taking off?
As far as Noida is concerned, it is as of today, we have still not got the approvals, and that is what is a little distressing. I believe there is a lot of pent-up demand in that region. The day we get approvals and we do the launch, I'm sure we'll get a good response. People have shown a lot of interest, but it's just a matter of being at the right place at the right time. We have tied up, in a small piece of property, but prime in KG Mark. and that's a good property. And I think that will come up also pretty fast. It'll be luxury. And we are building this hotel in Delhi in the Aero City, the hotel and office. And that's also construction is going on pretty fast. But where actual sales have come from is from Bangalore, Mumbai, Hyderabad, Chennai, and of course, Kerala. These are the territories that we are very active in. And these territories have given us numbers, and they'll continue to give us numbers because we have a lot of projects in the pipeline and all under approval. And we have a certain planned launch calendar for these. And I'm sure these are the projects that bring us the numbers. And if Noida does happen, that will add up to the kitty. And we are looking at various other options. But we have to be careful. Like you rightly said, we have to be extremely cautious. We have to be extremely careful. And we have to make sure that whatever we do it right and we do it well.
Good to hear that. Mr. Razak, what about pricing of properties? You know, that's been on an upward trajectory since the COVID lows for the past 2-3 years. But do you see prices escalate even further from here?
The prices have corrected themselves based on the input costs like labor, material, land cost, everything else. And they have reached a certain number now. And I probably would never want prices to go up more than what they deserve. And I believe that it will be counterproductive. So the best thing to do is prices will slowly correct themselves as we go along because inflation catches up and all of it. But it will not be a big, huge spike, which is not good for the business. And that is what we will always endeavor not to do. And we will always balance our need with our greed, and we will make sure while we look at our bottom line, we are not looking at some huge profits. We are always looking at reasonable, fair profits. And at the same time, we have to deliver a good product to the customer. That's always been our balance, and it'll continue to do so. And if you ask me in general, the prices should remain stable now because the moment prices go up too high, again, there'll be a resistance from the customers.
Mr. Razak, I have a quick follow-up on what Aisha spoke about on the pricing front, but from the other side. I understand that a lot of premium players, because real big volumes are there on the premium side, are resorting to very competitive pricing. You've also, kind of started expanding in premium areas of Mumbai as well, for example, central Mumbai. On the flip side, does it help to keep pricing very competitive and under check versus the current inventory? Does it improve volume prospects quite meaningfully?
No, I mean, it's common sense that if we keep the prices under control, if we keep the prices achievable, attainable to the consumer, there will be traction, there will be acceptability. And another thing that happens is see, once the customer also sees that they bought it at an X price and say after a year or two, the price has slowly gone up, correcting itself for all the inflationary trends. They also feel comfort that, yes, I bought this project at this price and now it's a little higher, so I've not made a mistake. But if you've priced it too high, if you've kept it too pricey and then later on the price remains the same or the customer still can buy it at a lower number, then there is going to be problems. So that is the reason it's always good to start at a lower number and then let the market forces decide how the price goes up. But at the same time, we as a company have always tried to see that we do not spike the price for no reason. There has to be a reason for it. We have responsibility to our shareholders and stakeholders to see that we protect the bottom line. While doing that, we definitely will make sure that the prices don't go up unreasonably high.
Razak, morning. Now, after the company sold a substantial part of the office and the mall portfolio to Blackstone, you've embarked on rebuilding the annuity portfolio. Can you tell us what opportunity that brings about for the company and what are the exit rentals that you're targeting for this portfolio?
Yes, now this portfolio, yes, we are rebuilding it. There are several projects that we are doing both in the office and the retail. We have held on to our the hospitality portfolio, and we are expanding that also. So, see, I can give any number, but the thing is, what is real? We've got now 3 trading retail assets, one in Bangalore South, the other in Kochi, which has opened up, and one more in Bangalore. So apart from this, we do have a lot of office that is already now leased out, the new crop. Plus, we have a lot more coming up in various cities like Mumbai, Delhi, Bangalore, and also in Hyderabad. Now, all this at some point of time, say by 2025, we are looking at another 2,500 crores annuity from these assets, and I think it's highly achievable. But the only thing is, it's a function of how quickly we put up these assets and how quickly we can lease them out. Leasing, I believe, is still not an issue. If you have a good quality location, good quality assets, customers are there. There could be some new inquiries. Plus, also there will be some shift from older asset to a newer asset. So that keeps happening. There will be a demand, and I don't see demand drying up in the office space. And we continue. In fact, this financial year, we should close around 3 million square feet of leasing.
Right, all the very best on all of those developments. Thank you so much for giving us more clarity on pricing, demand, as well as outlook for the real estate space and for Prestige Estates as a whole. That's the stock at 718. Dipped into the red, albeit very marginally. It's up 0.5% when it comes to the small caps. We'll take a quick break and be right back.
Back with the market in first trades, right here on 80 now. Let's just take stock of what the market is settling in at. And it definitely was a bit of a quiet start after 2 days of a steep climb. But now we're challenging that 19,800 mark. So a bit of a stiff resistance coming in, if you will, at that particular level. What's under pressure besides IT? Let's check in on what the likes of Reliance and HDFC Bank, the blue chips, are up to. Because as I see at the bottom of the pack, surely is TCS, which is now down 1.5% as we speak. What is Infi up to ahead of its numbers? And what's HCL Technologies doing? It's pretty much a trend across the IT pack. They're all tempered in trade. Infi flat, HCL Technologies marginally a little bit soft. In fact, talking about IT, let me welcome on board Apurva Prasad as well as Sandeep Agarwal to talk about what they've made of TCS's numbers and what they anticipate for the rest of the sector going forward. Apurva, Sandeep, both of you, hi, morning. Thanks for taking the time out and joining in. Apurva, what next from TCS, and what is it that you've made of the commentary? Are you getting any hint that they're out of the rough seas?
I mean, I think it's a bit of a mixed thing because there's some kind of a contrast there. So while the second quarter revenue performance seems to be subdued, but it's getting more than offset by, or at least offset by the bookings number that came through and the operational performance also, despite a flattish trajectory. So I think there's sort of contrasting factors, some elements that worked, some that didn't. It sort of nets off to not significant change in terms of how we were assessing TCS.
Sandeep, looking at how the environment is shaping up, are you getting a sense that at least the top 3-4 large companies, IT companies in India now are getting into a structurally slower groove of growth, which we saw, say, perhaps compared to what we saw in the last decade? Is that a risk?
No, so I think, this probably we are getting carried away by the last 3-4 quarters numbers because, you have to accept the fact that most of our business, 60-70% business comes from the developed markets, particularly the US. And in US, last 4 to 6 quarters, there has been continuous talks of a hard recession, soft landing of recession, sometimes hard landing, and all these things. And in this kind of environment, every business, every corporate, every enterprise, what they try to do is they try to spend what is essential and they try to postpone what is not so essential and could be postponed. So that cycle is going on, and that is what is clearly reflecting in all the large IT companies. In fact, I think the other way. In my view, digital is today indispensable for everyone. Technology is indispensable. The technology spend as percentage of revenues are going up across the globe for most of the companies. So I believe there is a strong structural uptick in the demand environment. It has been temporarily stopped because of recession fears and all the global uncertainties which we have seen in recent past. I think this kind of situation where you see a decline in revenue, these are always, and you can go and refer to history, always signs of bottoming out. Deal data is very strong. Anyways, H2, no one has much expectation because H2 is cyclically and seasonally a weak half. So I think, people are now looking at FY25, and FY25 seems to be very promising. Even large companies like TCS, we are expecting 8-9% kind of growth, and depending on the size of the company and how they are positioned, the growth can go up to 17-18% for the smaller names. So with that growth and some aid from rupee, USD rupee conversion, and also the sharp fall in attrition, we expect a better PAT growth. So I think these stocks have undergone time correction and some price earning multiple correction. So they are now in sweet spot. I don't expect a much decline from here. In my view, investors will come in and buy these names in next 1 or 2 months. That is what my sense is.
Sandeep, morning. Just for TCS in particular, what's the outlook when it comes to the margin? While the management wasn't too forthcoming in terms of an overall guidance, do you think that 25% EBIT margin could potentially be hit down the line? And where is it, or what is it that you think would be those drivers for margin growth?
So see, while people count price as a margin lever and growth and all that, but last 22 years experience of myself in the software industry, I can tell you the biggest margin driver is always a stable manpower, because this industry is purely dependent on manpower. 60% of the cost is employee cost. So if you always lose the track, or you always give up margins when your employees are unstable, and you always make better margin when employee stability comes back. So we are seeing employee stability coming back after like 7-8 quarters. So if you recall, post-COVID, while growth remained high, but margins were continuously falling because of sharp jump in attrition. Like, it was decadal high attrition. Now we are coming back to pre-COVID kind of attrition, and hence margins are slowly expanding. Now the thing which needs to come is slight bit of growth back, and when that happens, then operating leverage plays out in full form, and you will see better PAT growth. So I think the main lever of margin is controlled attrition, which has happened already. And I think in next 1 or 2 quarters, they will achieve 11-12% attrition, and that will be very good for margins.
Right. So, Sandeep, just wanted to get your sense, because there's Infi and HCL Tech as well next, right? What's the anticipation and expectation from there? Do you think what TCS did is pretty much a trend that one can foresee for the rest of the IT pack too, or do you think there could be some outliers?
So it cannot be much different, because what we have seen, particularly in case of TCS result, and based on the commentary, the consumer discretionary space is undergoing some weakness, and which is very natural, because if you see last 5-6 quarters, there has been uncertainty in US, and continuous rate hikes are happening. So there is cut down in discretionary spend, and when there is a cut down in discretionary spend, obviously all the budgets also see a cut, depending on how indispensable they are. So I don't see a very different number from, see, there could be some beat versus expectation, but I don't see a runaway number from anyone. This is going to be a little soft quarter, but what I will be more excited and more enthusiastic to see is what is the order book. So in my view, order book for everyone should be very, very good, and attrition number should come down. If that is happening, then maybe in 1 or 2 quarters, you will see a big bounce back in the fundamentals of all these companies.
So order book growth and attrition levels, how they pan out will determine how these stocks will actually be treated by the markets, as per Sandeep. Apurva, if one were to, in the pecking order of your preference, the top 3 names, TCS, Infosys, HCL Tech, even LTI Mindtree, how would your preferences look like in terms of valuations?
I mean, see, our preference within the large caps, and if I'm including LTI Mindtree within that, that's the one that we would prefer from an absolute upside potential near term. But after that, we do like an HCL Tech, TCS, and Infosys, in that order, and we're not as upbeat on Wipro and TechM. So that is roughly a tracking order.
I may, just to take off from what we were asking Sandeep about in terms of the fact that there is that anticipation that there could be a subdued demand environment, the US recessionary fears, etc. Is there a sense that we could see things improving, or is that potentially, or concerns of the recessionary fears, etc., likely to weigh down on IT companies as a whole going down into the second half of the year?
No, we do expect improvement. Now, whether it happens, say, second half Q3, or it starts Q4, or it gets a bit more protracted, I think that's probably more a near-term debate. But I do agree with Sandeep's earlier comment that the bookings number, that itself gives a lot of confidence of a much stronger exit. I think that's a key aspect. Apart from that, some of the operational elements have also become very favorable for the sector. So effectively, what's happening is your cost of replacement is coming down, is lower than the existing cost base, which is a good sign. So look at a scenario where the sector growth rates have decelerated from 12-13% to this year 4-5%. Margins are still sort of holding up. So I think that aspect could probably improve further with some operating leverage as that comes in the next couple of quarters. But yeah, I think deal bookings would probably be the key highlight, and we do expect even TCS and HCL Tech to report very strong deal numbers.
All right. Good to have you both on board. Thank you so much, both Sandeep as well as Apurva, for giving us a sense as to what we can expect from the IT sector in terms of attrition, hiring, demand environment, and of course, the quarterly numbers. That's the IT space as a whole in today's trading session. It continues to remain a bit subdued. Just checking in on what TCS as well is up to, currently at about 35.54. And by and large, you've got names like Infi, HCL Tech, which will be coming out with numbers, also in the limelight on the downside. Time for a very short break right here on the show. Lots more lined up when we return.
All right, so the first 15-20 minutes of trade, almost 45 minutes of trade, as we had discussed with our chartists also earlier in the day, 19,850 may turn out to be a bit of a hurdle, and that's exactly what has happened. If you look at the intraday chart of Nifty, you would see that the highest point of the day so far was made in the first 10 minutes of trade. So 19,830.35 is exactly where there was a mild softish gap down, and then we peaked out over there, came down. Same was the case with Bank Nifty as well. Bank Nifty was comparatively softer yesterday as well. Pull up Bank Nifty and have a word exactly what's happening there at the lowest point of the day. Small cap, mid caps has also come up. I won't be surprised if there is some amount of outperformance in mid caps and small caps. Yes, there is clearly 0.5% kind of gains coming in out there, because the advanced decline yesterday itself was very strong. All the sector indices you would see, all the small cap, mid cap, large cap indices you would see, the number of advancing were far higher than the number of decliners. So a broad based market is actually pretty okay. And if we don't lose much ground from here, that should also be seen as a positive. But let's take the discussion on wines and spirits and the trends which are taking shape. Leadership changes are happening. Q2 updates are coming in. It's the festive season and sports season as well. So Neeta Kapoor will also join us shortly, head of the Wines and Spirits Association, and Karan Taurani, who looks at the space very closely, analyzes it when he's watching matches or movies, because that's what his full-time job is, to analyze the entertainment space as well. Karan, did you check out how the Sula Q2 updates actually came in while you were watching your favorite movie or your favorite match?
We've not checked out Sula, it's not on the coverage, but we are like broadly positive on growth rates in the wine industry.
Yeah, so let's talk about that. I was discussing with Aisha and Awan earlier in the day that predominantly on consumption pattern side, India has been a country of hard liquor drinkers. Wine is overall a new subject as genre, and then within that, I mean, somebody was telling me that for every liter of premium whiskey, just 1 teaspoon of wine is consumed in India. What kind of growth has emerging markets seen on wine globally? Because after all, same kind of patterns will play out here in India as well.
So I think the wine segment particularly will see very strong volume growth. If you look at the overall industry in terms of spirits, the volume growth has been in the range of 4 to 5%, which is mid to low single digit. But specifically, if you look at wine, I think in terms of volume contribution, it's still very small. It's just about 1% odd in terms of the industry size of spirits. Now, the growth rates herein would be in the range of 12 to 15%. The reason for that is twofold. One is what we are seeing is that the consumption is going up in the existing cities, which are metro. So one has to not forget the fact that wine is more metro-led. There are top 7-8 cities which contribute a large chunk of the wine revenues or volumes rather. So I think there is increased consumption. That growth rate is somewhere close to 5 to 7%. The balance other half of growth rate will be led by moving into newer markets. So wine has got a very low penetration as far as tier 2 and tier 3 cities acceptance is concerned. So once we see that picking up, we'll see volume growth, moving towards 12 to 15%. And that's what is happening currently.
So introduce then Neeta Kapoor, CEO, International Spirits and Wines Association of India, who joins in on the discussion. Neeta, I just wanted to start off by talking about the UK-India FTA that's expected to be signed by the end of this month. Can you just explain what the implications of this could be on the alcohol beverage industry, what it means, how beneficial it will be, if at all?
Good morning. Yeah, sure. So with respect to the UK FTA, the major benefit is going to be on account of the bulk that is imported into the country. As the bulk imports into the country, you will see that all the Indian players will have a major cost benefit because the duty would be rationalized, hopefully, on the bulk also. Second is the consumers will get a lot more choices because you will have the finished product coming in even from smaller distilleries based in UK. So that means that there will be more choices for the consumers here. Third is all the allied sectors of alcobev, i.e. that you look at tourism, travel, food and beverage, agriculture. All of these will see an increase in demand and hence therefore contribution to the state economy that we contribute to. So all in all, it should be a win-win situation for both the countries.
Okay, fair enough. Let's also get in a sense from you then as to how you're looking at overall domestic players, Neeta, because they have raised concerns about a surge in the bottled scotch imports in the recent years without a reduction in the import duty. Now with a possible reduction in import duty, isn't this a bigger threat coming in for the domestic industry?
So this is what I call is essentially a misconception or a misperception being created because all the players in this sector have a significant domestic base. Whether I would talk about international players who have consistently invested in the countries or domestic. So it's very difficult to differentiate between who's domestic and who's not domestic, particularly with respect to the sector that I work in, which is the alcohol sector. So if we start with that premise, then we should be looking at the fact that how is it going to benefit the sector overall? How is it going to benefit the industry, the consumers, the state? I would, in fact, look at the FTA from that perspective. In terms of competition, look, I mean, we are talking about a Scotch segment, which is roughly about 2.5, 2.8% of the entire industry. And there is no way that, there should be any threat from the Scotch brands to the domestic local brands produced by our members, as well as the other association members. So clearly, I mean, no, I don't think that's a threat at all.
Karan, what are your thoughts on this matter? It's been going on for some time now, and now by month end, the expectations are that Rishi Sunak would visit in India, and actually this could be sealed. On the one hand, import of bulk bottled scotch and also export opportunities of Indian players, especially the listed ones, United Spirits, Radico, among others?
Two things here. I think in terms of broader positive impact, one very big positive impact is that the price of bottled scotch will come down, which is BIO and BII. Now, if you look at the price of bottled scotch today in India, there is a 50% premium versus the duty-free prices. If you look at it on a like-to-like basis, on a per ml basis. Now, this gap will, converge somewhere towards 25 to 30%. And for example, in the case of Maharashtra, which is a large state, the gap is already down at about 30%, which will probably move to 15%. So I think this will lead to a big boost in terms of consumption of scotch, offtake of scotch, which will have a positive impact in terms of United Spirits for potential volume growth, because they are the market leaders as far as scotch is concerned. The second impact is also that this will also have a negative impact in terms of upper prestige consumption. So if you look at something like a Blender's Pride, which is currently termed upper prestige, the gap between a Blender's Pride and a red label is 30% today, just a broader number over there. This gap will also converge towards 15%. So I think scotch offtake will really multiply in a very big manner. And that's one very big positive delta which is there. But this will only happen if this kind of benefit is provided to the customer by the company. If the states don't expose any kind of increased VAT or excise, after this duty cut of UK FTA which comes in. The second big impact is around profitability of UK FTA, which is going to be on the margin. That's because most of these companies, procure a lot of bulk scotch. Now, bulk scotch, if you see, is somewhere close to 4 to 5% of COGS for most of these companies. And after UK FTA, the prices of bulk scotch will somewhere come down close to 30-35%. So basis that, there could be a positive impact in terms of EBITDA margins for most of these companies because of bulk scotch as well. So the impact is twofold here. As far as exports are concerned, not a compelling play as of now. Obviously, in the future, things could pick up, but as of now, it's going to be more limited to high-end single malts, which are very small in terms of overall volume. So the overall big impact will not play out because of exports.
Sure, fair point. But that's an area where over the long term, perhaps things could change. You must have read about Indri, how it is making waves among the top world's top 15, 20 names. It's a small little listed company. I mean, we came to know about it later. But on valuation front, a quick follow-up there, Karan. Radico versus United Spirits, how are the valuations looking? Do they capture these potential triggers or not yet?
So I think in terms of triggers, United Spirits, the core alcohol business currently is trading at close to 54 times forward PER. Now, the potential upside is if you roll over to FY26, that's one, because there is a constant potential for this company to grow at 12 to 15% in terms of earnings because of the strong volume growth. So I don't think the entire positive impact of UK FTA has been factored in, because UK FTA will broadly lead to revenue growth upgrade of somewhere close to 8 to 12%, because it will have a positive impact in terms of volumes by not more than 2.5%, but your realization per case will see a bigger delta in terms of positive impact. So I think you could see an upgrade of 10 to 12% in terms of revenue, which will flow down to your earnings. But the problem here is, if you look at their BII and BIO portfolio, that is capped at a margin of about 10% and which may not lead to a multiplier effect in terms of your potential EBITDA. So I think in terms of earnings, it's more of a mild, flattish or a muted kind of an impact, but revenue growth will definitely multiply, because I think the Scotch portfolio after the UK FTA could grow at 35 to 40% for a company like UNSP. Now, as far as Radico is concerned, they don't have much of exposure to Scotch. It's more domestic-led single malt, wherein if the exports pick up on that very small base, which is less than 500 million cases, you will probably have some delta impact because of exports, but that's going to be very small. The bigger impact for Radico and UNSP both will be around profitability, which I told you, the bulk Scotch prices coming down. And I think basis that there is a potential earnings upgrade of anywhere close to 4 to 10% because of bulk Scotch prices coming down post UK FTA.
What about the industry grappling with high inflation, high taxation on ENA, barley, for instance, packaging materials? All those prices have risen multifold over the last few years. How do you see this impacting the industry? How are they dealing with it? Is there some sort of a moderation that's expected in prices soon?
So that is in fact the biggest challenge in terms of what is happening to the cost of the direct material. So for example, if I was to look at an ENA base, over a 5-year period, the ENA prices have shot up at around 11%. Just this morning, the news is that ENA from molasses will again be increased at about 3%. That's the inflationary trend that the news is reporting. So that is one challenge. Or glass, in fact, if I was to look at it, which is one of the fundamental materials of the industry, is up by about 29% over a similar period. Now, the problem is here, because Alcobev is the liquid economic engine of a state, the state controls the maximum tax on an MRP. So you will see that about 60 to 70%, and in some states, right up to 80% of your MRP goes to the state as far as taxes is concerned, leaving very little margins for the trade as well as the manufacturers. Now, there are some states who have not given a manufacturer price increase for the last 4 years, 5 years. Some do it selectively. Now, that is the biggest challenge. Whilst whilst volumes will increase, the margins are diminishing. And that's our job as an association. ISWAI is continuously engaging with states, sharing the data to say, please look into this and have an inflationary model for the manufacturers of Alcobev. And I hope, this comes about to say that let this industry, like an FMCG industry, look at an inflationary model and have a free pricing. So that's one of our biggest bane in the industry.
Fair enough. Thank you for sharing with us those details, Meeta. Karan, thanks so much for joining in on the discussion. Well, let's move on then from alcohol to sugar and discuss the long-term prospects for the sector as a whole with Atul Chaturvedi, Executive Chairman, Sri Renuka Sugar, is now joining us on the show. Good to have you on board. To begin with, there are some reports that are surfacing, Mr. Chaturvedi, yet again, that the sugar exports will be banned in the current sugar season. And time and again, you have reiterated that the sugar exports will not be allowed. Do you continue to maintain your stance?
No, I see no reason to change that view. In any case, the government of India is, in any case, very, very proactive as far as inflationary impact on the food is concerned. And I see no reason why sugar exports might happen this year. And more so because we are also having a lower production in probably Karnataka and Maharashtra. And in spite of whatever we may say, I don't think the government is going to open up the exports, and they will much rather prefer to err on the side of caution.
Okay, so reports are also suggesting that the quota for some overseas sales could be issued if the domestic supply improves during the year. Just wondering if you see this coming as a possibility?
You mean import into the country?
That's right, that the quota for some overseas sales could be issued if the domestic supply improves.
I don't see any prospect of that, unless it's a G2G kind of a scenario, which is happening in probably rice, that some countries which may be struggling for sugar, they might approach government of India and then some quantity might get allocated. But I don't see that scenario happening as of today.
Now, a few days ago, the company completed the acquisition of Anamika Sugar Mills. That was about 235 crore rupees. I want to understand what kind of synergies the company could enjoy, what could be the incremental benefit, particularly on your financials, if you could share with us, or your top line as well as on the profitability front.
No, as far as the financials are concerned, we are in a silent period, but I can give you the rationale why we've gone into UP. If you look at our asset base, we are largely concentrated in the state of Karnataka and Maharashtra. So it was important for us to de-risk our business geographically. And UP being a very big producer of cane, it was logical for us to enter UP. And secondly, we also have a strong brand called Madhur, which happens to be the market leader in the country. And moving sugar for supplying to UP and Eastern India was a bit of a logistical challenge. So with a unit in UP, I think that should help us in spreading the Madhur sugar in northern India, which is much more populous as far as that part of the world is concerned. So I think it's essentially to geographically de-risk our business, and that is the reason. And I'm sure it is going to definitely impact our both top line and bottom line as we go forward. That's the rationale behind it.
Just wanted to get your sense in on pricing as well, because sugar prices, as we understand, are on the rise globally because of the supply constraints from top producers like us, as well as Brazil too. Could you help us understand which trajectory do you think domestic prices would be headed in?
No, you are absolutely spot on when you say internationally the sugar prices are on the boil. And that's largely because Brazil happens to have a very good crop this year, but they also face a lot of logistical challenges. And they also had a very good soya crop and a good corn crop. And all these crops compete for the same shipping space. So that's a bit of a challenge. And they're not able to ship more than 2.5 to 2.75 million tons on a monthly basis. And with India out of the picture as far as export is concerned, India last year or rather this year has exported something like 6.3 to 6.4 million tons to the world market. So the world market is less supplied to that extent. And with Thailand also not showing a very good crop, and their crop is likely to be down to about 7.5 million tons. So all this is resulting in firm international prices. But having said that, that is not going to impact the domestic prices big time. Though some upward movement we can see as far as the domestic values are concerned, but that is largely a reflection of the inventories in the country coming down to much more logical level at about something like 5.5 million tons or thereabouts. So with our sugar inventories coming down, it is getting reflected in the domestic values, which are inching up. But we do not see the domestic values going through the roof. But we will have to probably accept that the new normal would be anything between 38 to 40 rupees as far as sugar from the mills is concerned. And 38 to 40 is no big deal because the price increase is only about 3-4 rupees from what it was a few months back. So I don't think government needs to worry too much on that count. And sugar prices would remain largely in check. And with the crushing season also starting in about 15-20 days' time, the sugar values should moderate.
The other moving part is also global crude prices, right? While in the last 5 odd days, ever since the turmoil in Israel began, they definitely have seen a cool off, but largely they are on the boil once again. Do you believe this is a great time then to start pushing ethanol blending further?
That's a very interesting question, because the delta between ethanol and sugar prices has shrunk. And if the ethanol prices are not moved upwards, probably you might see more sugar getting produced in the country. So we hope the government does not go back on its commitment of almost 20% blending by 2025, in spite of whatever little hiccups may happen. And according to what information we are having, I think the government is still committed for the ethanol blending program. And this year could be a minor blip, but still we would have adequate sugar. One thing which I would like to share with you is, even if the Indian sugar production falls down to 30 million tons, our domestic consumption is not more than 28 million tons. And when we say 30 million tons of sugar, this is after reducing 4.5 million tons of diversion. So if we exclude the diversion to ethanol, then your sugar production actually could be something like 34.5 million tons. which to my mind is adequate, and the government need not worry on ethanol ensuring that the sugar goes out of the system. I don't think it's going to happen.
Okay, good to have you, Mr. Chaturvedi. Thank you for joining in and pointing out all of those details and giving us a lot more clarity on the sugar industry. Well, with news that the markets are currently at 19,792, we're down about 60 points on the Sensex. We'll slip into a very quick break. Be right back.